movement comes not so much from the number itself, but the divergence of that number from the guesstimate, or the actual number from the guesstimate. So if you think about it that way, the number itself, all we're looking for is movement off of it. And that's all we want. So John, if we can jump to the next slide.
And like we touched on the other day, you so hit on this idea of the guesstimate comes from these analysts. And, you know, like I think we both decided we wouldn't want their jobs because I don't know. I don't, you know, I mean, they have all their metrics that they have to come up with it, but this is a precarious situation for sure.
It is, absolutely. And, you know, we both, you cited that 665,000 number, and it's what that is the average of all these different guys putting in what their guesstimate is. And they kind of, some guys may say it's going to be 200,000. Some guys may say it's 1 million, and they kind of estimate that down to consensus being around 665. And that's where that number comes from. It's not like every guy out there, the guy at B of A, at Goldman, at JP Morgan, all are picking this particular number. It's kind of a meld of each person's thoughts. So really a couple of spots, and we want to focus on a couple of markets and put together some trade ideas. And I think you hit on it too. Where is this going to play through? And I think your first call was equity markets. Absolutely. This will play through. And it seems like futures are that first mover. They're that pure directional play. So they tend to have that very quick reflexive move to it. Your thoughts as we start to go through products, and we have a lot of different choices here. What else would you be focusing on here?
So in my case, you know, besides any options or equity stuff, first thing I am going to pay attention to is my small US dollar future that I have. I'm interested to see what's going to happen there. You know, again, we're looking for a situation where if a lot more people have, you know, been added to the workforce, right, is that going to be a situation where people, you know, consumer spending is increased, which, you know, and it leads to increase of the dollar purchasing power amidst this environment of inflation? You know, again, I wonder. I mean, those are, it's almost two things butting heads. So, you know, this is going to be great. I mean, this is, I think that I'm trying to remember when I put my position on. It was a little over a month ago. Yeah, no, it was during the week of May expiration. So this is my first time having this future on during the non-farm payroll number. So that's going to be the first thing I'm watching. And then next, I'm gonna watch this 10-year yield, of course, because although we know this was a month ago and this was the last number, this chart that we have in front of us right here. So it was sitting around below that 16 or 1.6 number. Right. That 1.6 number has been kind of a magnet, right, Pete?
It sure has on both sides. It has really pulled and pushed the market in a number of directions. And this is around the non-farm. We had both the market trade lower, yields trade lower, and then trade higher. And I think you hit on that push and pull, especially for, and I'm going to call and see what you think, is now your dollar position is, you're up on your dollar position now, I think, with the dollar trading above 144 right now.
Yeah, I bought it at 144.5. I was okay, just below. And then when I rolled out, I think my purchase price was 143.25. So I'm just below it. Although okay, I'm up money today, but I think I'm just below. So right, we'll see, you know, how it shakes out. So I mean, I'm looking, as far as that goes, I'm looking at areas of, and I mean, my high levels are 2% above my original purchase price, which would put me at just over 147. Okay. And below would be just under 142, where I would, you know, have interest of either closing out or, you know, possibly adding. I don't know. It just depends on how I feel.
Okay. So John, let's jump to the next slide if we can. And you know what? I think what we're going to take a look at is, you know, again, you mentioned where are we right now? We're sitting right about 1.6%. Today, we're 10 years, a little bit higher, about 1.62%. So we saw yields trade ever so slightly higher this morning, a pretty big downdraft in equities. We're grinding right back into it. You know, a little bit of talk from the Fed today about them. They own a little bit of everything. They own ETFs, they own corporate debt, they own mortgage debt, they own U.S. government debt. And the idea that I think what we're looking for here is, if the economy is truly on an expansionary path, why in the world would these guys keep buying debt? endlessly. And they had mentioned today that they might let go of some of their ETFs and some of their corporate debt. And I think you're seeing that sensitivity of, if the Fed is not out there buying or at least holding, and they're what I call a price sensitive buyer, they don't care what they're buying at. They just have a mandate to buy so much. Where's the next level? What's a reasonable level to trade? And I think this is what we're going to get some sense of. Are we going to see 2% in rates, or are we going to see maybe a pullback to 1.4 or 14 in the index, or 1.4%? So that's going to be really interesting to see. Rates and equities are a tier one mover in my mind. They're going to be the quickest, most reflective piece. I think you and I both like trading the dollar. I look at the dollar as kind of a tier two. Doesn't make it any less interesting, but sometimes it doesn't have the legs after the reflexive movement that some of the other markets do. John, if we can jump one slide ahead, because I don't want us to think so much. So again, beat or miss, there's going to be movement. And that's exactly what you and I are looking at. So whether it be the smallest 10-year yield, it is the movement that we're looking for. So we're going to take a look at something that you and I get as subscribers to the small exchange. And John, we're going to go one ahead because I think really what we want to do, Jamal, is build some trade ideas. So let's take a look. And I want to hear your thoughts because there's a balance as a trader. When I started out, I traded one thing, and I'm really making myself old, D-marks, which don't even exist anymore, Deutschmarks. And it was required all your focus just to watch one single thing. Now, as you kind of expand, and I know you've done this, you add more product to your repertoire, to your portfolio, to create new strategies, new ideas. How much is too much in your mind? And when you've got an event like this, and either the number's going to come right in line and you're going to look at me, I'm going to look at you, and we're going to go, okay, what are we having for breakfast? Yeah. Or we're going to have something to do. And the question is, how many things, as a new trader, is it better to kind of look at everything or to pick a couple of things out? Where do you go to in terms of if one thing moves, if the consensus is not met with the actual number, everything's going to move by different degrees, but how many of these things do you want to keep an eye on?
So that's a good question, and I'll start that out by answering from an option standpoint. You look right now, and even if you're trading the stocks or you're trading the options, when you look at the meme stocks, there's probably some people who have 5 of them. That's probably way too much. Those things are moving like crazy. It's hard to keep up with, and so I start there because a lot of my background as far as trading was in a momentum trading group, and we traded a lot of things. And we had tools that helped us keep eyes on all kinds of things. So if you're doing that type of situation, that's probably too much. Now, coming into this situation, when I look at a lot of these, as we start to talk about where, what we're thinking about as far as trade ideas, I would say I certainly wouldn't have a position on all, but I would pick maybe 3 or 4, particularly that I think are going to be affected by this number coming tomorrow. So, starting with like the small stocks, for example, I think, that's a big one because small stocks, have really been has really been pegged to a lot of this reopening trade that we talked about for the past year or so. And so you would imagine, again, the small stocks, or you could say small companies, have definitely been affected by a lot of the pandemic, a lot harder than the larger companies. And so as a result, you would expect, I'm sure there's been movements in the past non-farm payrolls. I would expect there to be some movement tomorrow for small stocks. So that's one that I'd be looking at. And where's that? Well, this is with confidence level, we're saying our move is around 1.07 for small stock 75. Yeah, right. So that's kind of like the straddle in a way, almost, if you will, right?
Yeah, absolutely. Yeah. That's the as that math and science mind works, the one standard deviation, 68% confidence interval. So when we're looking at trades like this, do you start with a bias? And my question is we don't know whether the number is going to be good or bad. And certain products, for me, I find these numbers great because this shows me what a normal day is giving me right now. And it's over a full point in the small 75, right about a point in sticks. For outlier days like today, tomorrow, excuse me, that tend to have more movement, I look at scalping ranges on either side. Would you?
Yeah, certainly. I would look at scalping, especially on a day like that, because like we just saw, from our previous slide, when we saw what happened on May 7th for the 10-year, we saw a nice, up move, and then we saw a quick down move. And so I think that presents opportunities for potential scalps. So, I mean, that's definitely something you look for. You're right. I definitely would look for that. And having this type of, thing here that shows us the distribution of potential moves is helpful.
Agreed. Sure. Absolutely. Because it's a quick reference because, all futures aren't created equally. Everything has a little bit different movement to it. We were looking at SM75 for a long time, having 70 points of movement to it. Here we're up over $1. So so we're going to, and when I say we, I'm so interested in hearing your thoughts about this. You focus on SM75 and the 10-year as being kind of those most impacted piece by this binary event. When you look at a standard day and let's just stick with SM75, is 107 ticks. If you're setting up, I call them non-denominational. It's just my term, but a non-biased scalping range. In other words, if the number's off, the market may move. And I don't mind if it moves down or up. I just want the action. So are you going to use that normal day's movement? Are you going to widen it out? Do you have a bias where you might use one standard deviation on one side because you like the idea of being long, and you may use two standard deviations on the other side at 200 points because you're not as inclined to be short, but if they get up there, that's a pretty big move not to fade.
Yeah. So this is, again, another great question, and I'm going to start it off with the idea of options, because the nice thing is that I don't have to think about it from the standpoint if I'm buying vol or selling vol for this straddle, if you will. And then if it doesn't work out, whatever. So yeah, I wouldn't anticipate the 107 ticks. I'd probably go half. I'd probably say, it's going to move, 53 ticks, if you will, just in case, and, kind of look at it from that standpoint. Now, do I have a bias? I mean, maybe a little bit, considering today it's almost interesting. You almost have this like free look, if you will, from the two numbers we got today with the jobless claims and the ADP. We saw jobless claims move down and we saw ADP kind of go up, both maybe pretending that we're going to see a number in line or a little higher. We'll see. But I would start with that bias from that standpoint. And so that being the case, I'd probably think about getting long small stock 75.
Okay. So
to the tune of maybe, expecting 53 ticks, like we said.
Okay. So you're going to put some resting orders in 53 ticks on either side of roughly where we are pre-number.
Yeah. I feel like I'm like picking teams to win something.
Yeah.
Right
this
is fantastic.
We actually are. We're trying to build a little bit of a parlay. So
yeah, I'd be long that for 53 ticks.
Okay. Very good. And would you be short for the same 53 ticks looking for the reflexive move? In other words, if we had the up move, and it's just a function of divergence of actual number versus expected number, would you have the same non-denominational bias?
I would. So I'd think about, if we're going to expand on it, I'd be long that for 53 ticks, expecting a number of 650,000 for the payroll. I mean, for the non-farm or higher. If for whatever reason we came out with 1.5, I'm going to sit and try and get to the 107 at the very minimum.
Okay. So you're not going to put resting orders in before the number comes out. You're going to wait for that reflexive move.
Yeah. That's just, kind of how I'm built. So I wouldn't, in this case, for this one day, considering, like I said, versus my small dollar situation that I have, which is, I'm looking at that as a longer trade.
Well, and that was going to be my next question. So you've got a bias in the dollar. You're long dollar. Now, at what point if we get probably a dismal jobs number, which would cause the dollar to soften, which meant the dollar index would fall. Let's turn this around. I'm sorry. Let's say it's a good number and the dollar index rallies, and you're finding some profits on your long position. At what spot would you say, I still like being long the dollar, but a 50 tick move, a 100 tick move on a reflexive one data point, I'm willing to take some off. Now, sometimes you're wrong. It continues to run up on you. And you're like, oh, geez, I should have held on to them. We all have I should have held on to them stories. What point with a bias would you consider harvesting some profits? Or would you not? Would you be like, I just want to hold on to these? And I've got a downside, as you mentioned, a get out level if I'm wrong. But would there be one standard deviation? Two, would you take 135 points? 3 standard deviations out?
Yeah, so I actually liked where you started it. And I'm going to start there too. If the dollar went down, because it is relatively depressed, and we do have this inflationary period, whether it's transitory or not, I do think it's transitory. But again, what is transitory? Is that 6 months? Is that 9 months? Is that a year? I'm not sure. So that being the case, if the dollar were to hit my lower level, which is below 142, I probably would close out for the time being and just reassess. Now, on the upside, for the, just say that it is based off of the non-farm payroll number, and it starts to move to the upside. Again, my upside, it's 2% higher, which I don't expect in any one given day, given, the dollar type moves. But if it got there, I probably would close out, and again, I think this is something that for those who haven't done this yet, it's about your mindset. I don't anticipate a big move like that, but if it does, I'm fine closing it out. And, the whole, I don't know what the kids say these days, YOLO or HODL, whatever, but I'm not expecting, I can get back in, say it does get to 147 for whatever reason, and I close out and I sell out, and I have no position, and it continues to go and it gets to, 150. Maybe I look there to get back in because now it's a new narrative. So.
Okay, very, very good. So we've walked through, Jamal's really taken us through some of his trade setups going into this non-farm payrolls number tomorrow at 7:30, and trading the reflexive nature of the market reacting to a set of data points. And we can argue they're relevant, they're last month's. That's not what we're not grading data points. All we're looking for is tradable opportunity and using metrics to set up some tradable opportunity. So you've certainly set us up for some good ones and looked at those levels in small 75, in the dollar index, in 10 years. So it'll be fun to see how this plays out tomorrow. Lots of tradable opportunity. Those statistical levels, that 1, 2, and 3 standard deviations, we start talking about moving that 50-50 game of binary outcome. In other words, I'm long or short, I make or lose, moving those odds a little bit. These numbers help you move the odds a little bit because it talks about a non-standard day and a standard day in terms of movement. That's where we look for our ads. So Jamal, it'll be interesting to see how this plays out, and we'll recap it early next week when we get back together again.
Yeah, we will. It's going to be interesting. Like you said, this is almost like an earnings type of event, which I'm used to in options. And, so this is going to be cool. We'll see what happens.
All right. Good deal. Guys, thanks for tuning in. Stay tuned. Next edition coming up of Small Stakes. We'll see you back here in just a little bit.